All right, another day, another record high for the S&P 500. We're not quite seeing the same thing in some other asset classes, so I'm going to show you some divergences that's going on between stocks and some of the other major asset classes that are out there, what that might be telling us, especially in regards to either inflation or deflation. I'm going to talk about this big move that we're getting in the dollar right now and the impact that it's having on some of these asset classes, what that means for risk appetite. And then finally, we're going to take a look at a trade on a stock that's got earnings coming up this week that's got a good bullish pattern in and of itself without the earnings. So let's go ahead and get started. Today is Wednesday, February the 19th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator, and you can see the nice little rally we had again today. We kind of have to continue to move up these lines now to new highs for both the fans and the retracement levels, just to continue to get an idea of where, again, at some point in time, that the intermediate line will drop below 50. The question is how and when, as we continue to pull this out. You look to see, okay, when could it happen? When do these lines cross each other? You're looking at potentially past March expiration, when the 50% crosses over here. You also see, beyond that, you're right at March expiration. You're right a little bit past it, or a little, beyond that of how far, if we have the deeper pullback here. So that's kind of gives you an idea of when and how long. You can see the next Fibonacci time series actually lines up on May 1st, the very first beginning of the end of this bullish seasonal cycle that we're on. So and we just barely passed the 89th, but so far without a significant move. All right, we continue to have a strong bullish intermediate posture. The near-term line still in the upper half of the chart for us to would be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days now. The typical run 7 to 12 days. Considering that this wasn't expected to be a very long run because we're very mature in this cycle. It's been a nice good run off of this bullish pattern of light pink shading and a yellow line, which is usually a bullish pattern. The closer you are to the beginning, it's like getting a cluster at the beginning of an intermediate run. Getting this pattern towards the beginning too, like within that first month or so, is a pretty good sign. But in this case, we're over 3 months, and now we're 4 months into this intermediate run, with market sentiment also very high. You look at the Russell 2000, and there's a big difference here. Not a huge difference, but you can see the intermediate line's not above 80 yet. It's been slowly crossing. It's crossed up above its market sentiment, which is still falling. You do have light green shading and dark green shading and a green line, but we don't have new highs. So the Russell's really not able to get going. Its near-term line has pulled back below 50 and is bouncing up above it. So it's been a little bit weaker. It's been lagging behind. Obviously not the Qs. The Qs are what's in the Qs, at least. From a market cap weighting standpoint, is what's really driving this market right now. And then you also have the diamonds, which has some element of some of those stocks, Microsoft, Apple, but not all of them. So you can see it hasn't been as strong either. Its near-term line has pulled back below 50. Its intermediate line still above 80, but you can see we had pulled back below 50 on the intermediate posture. We didn't quite, we did get below the 23% retracement. We didn't get to the 38%. So we were briefly negative there. And I believe a lot of that, I believe Boeing had something to do with that day, July 31st. But that was actually that worst day of the coronavirus fears, before we went into the weekend into February. And since then, we've really rallied up pretty sharply. In fact, if you look at the Russell 2000, we were also dark pink shading and red line at that point. Its intermediate line was actually not only below 50, it was dropping below 20 at that level. So, on July 31st, we had gotten to the Fibonacci retracement zone there. The Dow had gotten past its 23% retracement. The S&P never did, right? And in fact, its intermediate line never did cross below 50 even. We bounced back up again. So it kind of gives you an idea of how strong and how bullish and mature this bullish run has been, and how we've had some weakness in some areas in equities, and we continue to show some lagging performance in those same areas where we had shown more weakness before that we haven't necessarily shown yet here in the S&P. If I were to take a look at that DMI, as I've shown you before, this DMI continues to show divergences patterns setting up with the lower highs developing. You also look at the trend strength indicators for the S&P, and we are back to a moderate bullish strength, right? We had a really strong bullish run. It had ended. We got pretty noisy, but we're back to a moderate strength, and we have a very strong trend going on the weekly chart. So we are in the midst of some strength and a trend, a very strong trend right now. You know, you look at those Bollinger Bands, you know, we are well above the value area, well above. You know, when you get so far above the value area, again, a lot of this volume is going to come off, and the value area is going to slowly gravitate to include this volume. But still, that just shows how strong the trend is, how bullish we are. And then, of course, here's the retracement zone. That once you get into this shaded area, the retracement begins, and then that big pink area acts as a big old support level, which happens to line up in this case with that particular volume node, which will also act as a support. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, hit that thumbs up icon that's down below the video. That tells us two things. Number one, you got something out of our video today. You liked it. Number two, that you want us to do it again tomorrow. It's a quick way to give us feedback. You can do that right now while you're watching. Also down there, comment. What did you get out of the video today? Let us know with a comment down in the comment section below. Join our website at marketscholars.com. There's a link right there in the top right corner of your screen. Click on that link. It takes you to a page on our site where you can subscribe for free. Follow me on Twitter for more content in between the videos from day to day. And join our Market Outlook Facebook group that we've created. Of course, if you're watching us here on our website, I invite you to check out our Market Outlook live videos that we do. They're available for our monthly subscribers, monthly plan subscribers. You can get more information on that right above the video here. This video's Market Outlook live video. We check out all of our trades that we've been doing in these videos, all the trade ideas. We continue to monitor them all the way up to the time that we close them. We also put on today's trade idea before the market closes, so you kind of get a little preview before you watch the Market Outlook video later that evening. There's also our classes. You get access to all of our trading rooms, not our Q&A. Our Q&A sessions are unique for our premium subscribers, but all of our monthly subscribers get access to all of our 8 trading rooms that we have. So you can check that out. We also invite you to engage with us on social media. Hit this little heart right here. It opens up a page. You can like today's Market Outlook tweet. Hit that thumbs up. You can like today's Market Outlook Facebook post. When that page comes up, again, the more you engage with us, the more those platforms will promote our content to the top of your timelines. That way you always see our stuff. They will always make sure you see the stuff that you engage with the most. We try to make that really easy for you to do here on our website. All right, let's get back to the charts here, and let's take a look at the long-term view for the S&P 500, and look how bullish these candles are. It is looking very similar to January 18. As much as I haven't thought that this was January, similar to January 18, we are getting pretty similar now, where our PPO is about as high as it was at the beginning of that run. We were starting into some transition, like we were there. We were starting into some transition, and then we blew that transition away by closing with a really bullish close last week, and following that up with a really bullish candle this week and rising. It's really kind of hard for it to get too high. What this means is the 50-day moving average or 10-week exponential is about 7% away, and that's pretty decently strong. If you take a look at the 3 green arrows, of course, you have 3 green arrows on the S&P 500. You notice that MACD is falling. Despite the bullishness we have, that MACD is falling, which means, again, that the MACD itself can only go up so high before things just slow down, right? This is a momentum indicator, and usually you have a momentum push, and then we slow, and that's what we're doing. We're slowing, so we're not falling, so the MACD is not falling, and its moving average is rising back up to these really high levels. But that's what the histogram tells us. The dark green bars tell us that we're losing momentum. All the while, the bulls are about as in control as they can possibly be, according to the stochastics indicator. All right, if you take a look at the intraday chart for the S&P 500, again, you can just see how we rose up above last week's highs after gapping up early this morning. We still haven't filled that in. This move, this little area that we've been in for this past week, has become the point of control for this. You can see how we've got 3 days here left before that volume node pretty much is gone. All of the volume, there's some volume in this spot, but it's not going to be very much. Most of this volume is over here in this area, so the volume is really light over here. So that's going to be taper off, and we're going to have a pretty big gap in volume from this 336.74 level down to the point, to back when we get down into this area. And then that volume node is really going to taper off too, as this starts to come off. So, we're not going to have a whole lot of volume support below us, not only on the intraday chart, but also on the daily chart. You can see, again, all the volumes down here at the bottom. So we've really made a run, and it's been on very light volume, as you can see. And there's some chunks, but not very much. So this kind of shows how sharp and how strong this move has been. Usually you run up, you pull back, you develop some volume. You have a little bit more of a volume. You run up some more, you pull back, you develop some more volume. But the pullbacks have been so shallow that the volume hasn't really built out hardly at all compared to where the biggest chunk of volume is over here when we had these intermediate pullbacks. So again, that's just a reflection of how strongly bullish we've been and how we've been able to go. You see with the zigzag chart, we've been able to go without even a 3% move, right? If I were to change, obviously you can see that 2.5 right there. If I were to change this to just a 3% run pullbacks, well, we did have a 3% move there. Let's go to 5% on this, which is kind of your typical, intermediate pullback, right? When you've had a 5% drawdown, you've had your intermediate pullback, and obviously we haven't had one. There's the last one. That was a little miniature intermediate pullback there, but you can kind of get an idea. If I were to go back, here's the 5% pullbacks in 2019. We had 4 of them in 2018, which is a reflection again of how, actually 5 of them, which is a reflection of how volatile that period was. In fact, within this 18 months from January to October, to that October low point, which is where I think this period of volatility kind of ended. We had 1, 2, 3, 4, 5, 6, 7 5% pullbacks in a matter of about 18 months or so. So that kind of shows you just how volatile we have been. Coming off a period where we didn't have a 5%, we only had 1 in 2 years. Well, 2 in 2 years, 1 in almost 2 years. That wasn't even right before the November election, wasn't one. So, and now we're up 20% without one again, and we've gone 43% there. But outside of that move, this is a pretty, this 25% rally that we had off of the December low was pretty significant. Now, granted, that was off of a low point, a pretty sharp low point there. We're not coming off as sharp of a low point, but you can kind of tell, and we are coming off a pretty significant period of volatility. If you look at the Russell 2000, it's even more. You can see, again, since that January peak, 1, 2, 3, 4, 5, 6, 7, 8, 9 pullbacks of 5% or more. And obviously, we got another one here where we didn't get on the S&P 500. So you see how things have changed from a risk appetite standpoint, and it's really driven largely by these big, large cap stocks. In particular, you got your Facebook, Apple, Amazon. These are your 5 biggest companies, right? Or 5 of the 6, 7 biggest companies, and then Microsoft. You look at those and you can see the run that they've had as in conjunction with each other. That their breakout right there was what's really causing the breakout in the market as a whole, and they hadn't broken out until just recent, until the end of the year, right? Really, right there is their biggest breakout move that we had during the holidays in 2019, and they've really gone kind of parabolic here, and that kind of gives you an idea of why and why we're as bullish as we are. It's being largely driven by these by the largest cap of stocks within the S&P 500. Let's take a look at today's volume. Let's see. Excuse me. Sorry. This chart right here. You can see the volume is at under 49 million shares. The range today was just minuscule. If you take a look at the close, 336.73, and the low at 337. So we had about 3/4 of a point there of gap that we didn't fill in. So you have to add about 3/4 of a gap. But you're still at about less than 2.5 points. Yeah, about less than 2.5 points there. And the average range is 3 points. You can see there's the ATR, which is below the 1% point. We're obviously today's move below 2.5% is below that average. The volume at 48 million down here is below that average. So we are continued. The more days like this we get, the better for this bullish trend. With the ATR below the relative ATR below 1%. That's a pretty decent sign. The one thing that's not kind of confirming this bullishness is the VIX. You can see we are jumping up to new highs, but we're not dropping to new lows in the VIX. In fact, after Friday's move where we dropped below 90%, we're right back up and still holding this 90% level. So we haven't really broken through that support level. And when you don't break through that support, you tend to get bounces off of these levels and another little leg higher before we finally break through. And that's definitely a chance that can happen here, considering that we still haven't had an intermediate pullback on the S&P 500, which is what the VIX tracks. All right, so just to summarize our technical outlook before we look at some more, what's driving the price action here. Obviously, the market posture is bullish. We are strongly bullish. We're on a mature intermediate run. We're on a mature near-term run now. But again, the markets can stay, and you might not think they should be bullish. They're definitely mature and setting up the possibility for pullbacks. But they can still keep going and going in the same direction that they are in the process of going for as long as they want to go until there's a catalyst, right? Intermediate pullbacks where the intermediate line pulls below 50 does not start without 1% moves. Without a VIX that jumps up above that the 105% level, at least 105% level, and really quickly, and it doesn't start either without a catalyst. There's got to be some reason to spark that, and right now the market, even with this coronavirus, that was about as close to a catalyst as we got, and it still never met those levels to bring the S&P at least down to these kind of benchmark pullback levels. So we continue to trend. We continue to follow the path of least resistance, which from a volume standpoint tends to be to the upside. The problem is there's just only barely a little bit more resistance to the downside in terms of volume, because we moved up so much so fast without any pullbacks, without the volume building up below us. That it's that there's not very much that we can fall faster than obviously we rose, because for that very reason. That's kind of where this idea of market takes the stairs up and the elevator down, or falls off a cliff, whatever analogy you want to use. That's one of the main reasons why, if you grind higher and you keep going at a pretty decent pace without the volume to support it, then that means there's not a whole lot holding it up either. So what do you think? Do you agree with that assessment? Do you disagree? There's a link right there in the top right corner of your screen. Click on that link. It opens up a poll. Then hit either agree or disagree. If you click disagree, comment down below as to why. What are you seeing that suggests either you're a lot more bullish than I am, not expecting any pullbacks at all for a long time, or you're more bearish than I am, that you think we're going to be tanking. We've already had our catalyst, and we're going to be tanking here sooner rather than later. So let us know why, and what determines what gives you your opinion, or what you base your opinion off of, down below in the comment section. Now let's take a look at what's driving this price action. And this is the interesting chart. In fact, let me show you this chart first. Let me go back to the 4-week chart and take a look at a comparison of the S&P 500 to other asset classes, other risk asset classes. For example, like crude oil, right? Crude oil had a pretty good day today. But you notice again here, excuse me. It didn't pull up crude oil, did it? So let's do crude. There we go. So you can see here, let's go back actually 30 days so we can see a little bit longer view. I don't think 90 days, I think that's too far back. Well, you can see here's the 90-day mark. So here's crude oil 90 days ago, and crude oil started to pull back, of course, before the stocks peaked. And by the time stocks peaked, crude oil was down pretty decently from a peak of $63.50 all the way down to about $57. But since then, as stocks pulled down, they made their little pullback here. That wasn't even a 23% retracement. Crude oil really dropped. It dropped from 57 all the way down to 50, just below 50. Well, as we have now since rallied well beyond that peak at 332, and we're at 339, crude oil is not even anywhere close. It is finally up above these highs, but this is the last high point that kind of coincides with where we're at in crude oil right now, and there's the high on stocks that coincides, and we're obviously, that high was at 328, and we are at 338. So that kind of gives us an idea of how these other risk asset classes are doing. Here's the 10-year note, and this one's even worse, right? We're not even, we've bounced up to new highs compared to last week, but we're not even close to new highs on the 10-year yield compared to last week, or the week before that, or definitely back when stocks peaked themselves, or when the 10-year note peaked itself. It's about the same time that crude oil peaked. So you get the idea here that we're not really getting the same move overall in risk appetite. In fact, if you take a look at what's really been driving the movement here over the past couple of weeks, if I were to do a custom chart here. So crude oil, nice good rally the last couple of days. So it's made a big push up to the upside, really off of this 3% drop, now up 4%. But during that same time, look at gold, look at the US dollar, and look at bonds, all going up in conjunction with stocks. So stocks is really the one asset class that's kind of unlike all the others, right? Preferred stocks is down, developed market stocks are down, emerging markets, small cap stocks are all lagging behind, and S&P for that matter is just barely up above the US dollar for the same time frame. Go out that 4-week period, so 30th and the 23rd, you can get an idea again over 4 weeks. You have real estate, bonds, gold, and the dollar outpacing everything. And you have the S&P 500 kind of lagging behind. So, really since this low point where bonds bottomed out there and the dollar bottomed out and gold bottomed out, and you see commodities finally rallying, but they're down over the past 4 weeks, still 6% despite the rally. Emerging markets down 2.5% despite the rally. I mean, this is a risk-off move that we've had over the last 4 weeks. So the last 4 weeks, that's in conjunction with this 4-week range on the S&P 500. In conjunction with that, we're getting this comparison here. Here, let's remove all these and take a look at a comparison chart. 1, 2, 3, and 4. So if I were to take a look at the S&P compared to bonds, nope, not TLTFF, just regular TLT. So let me do this here. There we go. And then gold. So we'll put that on there. And then we'll put on real estate stocks as well. And then we'll put on the dollar, the ETF that tracks all of these. And again, here we go. Here's that 4-week move, and you can see there is, there's all these safety asset classes that are all outperforming and doing very well, pretty much since that, if I were to go and take a look, so not just the 4-week time frame, but since January 31st, since the time that stocks bottomed out pretty much across all the major indices, since they bottomed out, there's the S&P 500, there's VN real estate stocks up 3%, there's the dollar and gold up 2%, and then there's long-term bonds up as well, all up since the S&P 500 itself went up. In fact, this is here. Let's go. This includes the beginning of the 31st. Let's go to the end of the 31st. So let's come over here to February the 3rd, the beginning of February the 3rd there. There we go. And there was a little bit of a gap higher actually, but you can kind of see, again, what's outperforming here. And there's real estate right along with the S&P, and then there's your safety trades all rallying during this time that equities have been rallying. So it kind of gives us an idea. And the other thing too, from a risk asset class standpoint, this has not been a very broad rally. You saw the lagging small cap index, which means that it was not very broad in that perspective either. And then if you look at like the major indices out there, all the major countries out there besides the U.S., and you can see, there's Canada, there's Italy, and there's the U.S. that all have dark green shading, green lines. Nothing else really does. Germany slightly does, but everything else is dark red or dark pink with red lines, or dark green with red lines, or yellow lines, or light green with red lines, and light red with yellow. I mean, we're not getting broad participation here either, and a lot of that actually has to do with how bullish we are right now in the dollar. Look at the dollar index, this futures contract that tracks the dollar against this basket of currencies, and it is about as bullish. It's got about as bullish of a MACD as we've had since way back over here. Really, this initial run back in May of 18, we had a really bullish run that ended with that ended with that divergence, and then we're grinding all the way down to zero. Had one little pop before going below zero, another little rally, and then we went below zero again. Well, here we are. I mean, this is a pretty strong run for the dollar, and with the buyers is in control here, even more so than we were over there. That kind of just shows how bullish the dollar is, and that's putting a lot of pressure on commodities. It's putting a lot of pressure on international stocks. And again, it's not usually a bullish sign for risk appetite when the dollar makes such a strong move to the upside. So now let's take a look at the sector performance, and obviously the sector performance does reflect that risk appetite. You'll see it right here in the 12 grid. These three across the top, that's where your big tech names are: technology, discretionary, and communication services, and they're doing really well. Everything else, not so much. Financials is dark green and green line. They're all dark green and green line except for poor energy. Look at the evening star candlestick pattern on real estate, and look at the utilities dropping down too. Those were safety trades that were really bullish. Staples even have an overbought cluster. That's not typical of a bullish risk appetite either. And we're pretty sideways in these other cyclical areas. Healthcare, obviously part of that cyclical, part of it's non-cyclical. You can see financials, industrials, materials, all pretty flat. Energy obviously down. So it's really these three up here that's been driving how bullish we are right now. In fact, we're at 95 on the S&P, and those three are all in the mid-90s or higher, and nothing else is except for utilities and real estate, and they appear to be showing some signs of weakness there. So, again, you see from a sector standpoint, it's pretty risk on. It's just being driven by your cyclical areas, which is what you typically expect. These areas are the ones that typically lead in the later stages of a long-term run. So you can tell that we're not in the later stages of a long-term run right now. Not anywhere close. We're in the middle stages, which is where these guys really take over. Initially, it starts with industrials and financials, and they tend to lead the way higher. And now we've kind of taken the baton has been passed from those two areas to these three, which is very typical rotation. And then eventually that baton is going to be passed from those three to these two, and then from these two to these three down, or these four. Healthcare can kind of go in between. But these three especially, that baton will get passed to the point where they're the ones leading. They might still be pink, but they'll be leading their areas. So right now the baton has been passed to these strong cyclical areas, and we can ride those up for quite a while. Just a reflection of that bullish risk appetite, at least in U.S. stocks, especially among the largest cap of U.S. stocks, which are focused pretty much in these three areas. All right, so for our trade idea of the day, let's take a look at First Solar. If you look at its market forecast indicator, it's just barely turning positive, and a little bit of a breakout of small little pennant formation here. Breakout pattern today, moving up to higher levels. You can see the intermediate line rising. That's what gets the dark green shading. The moving average is now rising. We're coming into an earnings announcement. Market sentiment's rising. If you take a look at its 3 green arrow chart, you'll see that we have both the 8 and the 17 day now have crossed up above. The moving average for the MACD has crossed up above. We have a nice good surge in momentum, renewed surge. The buyers are in control according to the stochastics indicator. From a long-term standpoint, you can see we're still kind of in death cross territory, but we are above the 50. We're flirting with the 200. We have an opportunity for breakout pattern here. If you look at its Bollinger Bands, we are pushing the upper band up, clearing this volume node, working our way towards another one here, and of course breaking through that, we're into the path of least resistance and our way to the upside. Looking at the Ichimoku cloud, you see we're crossing above the cloud, which is a very good breakout with now a moderately strong bullish trend pattern developing. This DMI is also showing a bullish breakout pattern potential with the positive well above 25 all the way up above 30-35 area. So a big surge, which usually you get at the beginning of good intermediate runs. Big surge here with the drop in the negative directional index all the way below 20 with a rising ADX. If you take a look at the linear regression line, here we go. If you take a look at the linear regression, we are moving up into the upper half of the chart again. We've done this before, but that's also a good sign to clear our way from what was the lower half, kind of a breakout. And again, we have earnings coming up, and that's the biggest story here. So if you take a look at the trade that we did, we sold the 65. Remember, we do these live before the market closes in the Market Outlook Live video. So a reason to check that video out if you're not already if that's not already part of your habit to do. And you can always see the archives of those are always posted on the same page. So check those out. But we sold the 65 call, bought the 62.5 call. So what that looks like here, if I were to come over here to the chart, is essentially we're buying an out-of-the-money call option for $1.52 in case we're bullish, but we're covering 90 cents of the cost of that with this short 65, which caps my gains now. It's like a covered call. It caps my gains at 65. So that's what it looks like. There's where we are here. You can see if we go up, the purple line tells me where my gains will be, and of course, I position size here even less than half of my normal position because of that earnings, because there's a really good chance I take that full max loss. And in the past, I've position size for half of my position, but with this earnings, it's going to be hard for me to keep it to 50%. I would like to get it to 50%. If we drop and we can get out with $160, roughly $180, I think, loss, then that's what we'll get out at if we can keep it there. Then that makes our $1,400 reward for $180 of risk worth it. Even at $357, you're close to a 4-to-1 reward to risk ratio if this works out to the upside. And of course, the volatility suggests that there's a good opportunity. And if we go up, that will stay inside, most likely, this volatility band. And if we drop down, it'll probably pop out, and I'll just take whatever loss we have at that point. So kind of an earnings play, but on a stock that without the earnings is giving you a pretty good bullish pattern in and of itself. All right, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link right there. It's popping out in the top right corner of your screen. It takes you to our forums on marketscholars.com. You can open up any new thread and ask me any question you want about what I covered in the video today, or for that matter, anything I didn't cover that pertains to the topic. Again, remember you have to subscribe, but you can do that for free with how I showed you earlier in the video. But then we can keep this conversation going between our next video that we do. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below, follow me on Twitter for more content in between the videos, and join our website at marketscholars.com as well as our Facebook group that we've created. Have a great rest of your evening, everybody, and we'll see you all next time.